So let me just start straight into it. We don't have much time. Inflation is something that used to be a real challenge for economic progress, particularly in the 70s and into the 80s. We had often high and variable inflation rates, up around 10% or so, sometimes a little more, sometimes a little less, in many advanced economies. But ever since the 90s onwards, inflation really hasn't been much of an issue. Central banks were able to keep inflation within their targeted levels, usually somewhere around about the 2.5% level or thereabouts. But with the onset of the global financial crisis, and in particular, the central bank policies that were implemented at that time, there's kind of been a bit of a concern that inflation might start coming back again due to the large levels of liquidity that it's been around. And more recently, we've seen some data that have certainly shown a fairly large rise in the consumer price index, which is the main inflation index used by most countries around the world. And so a lot of people have started to think, well, look, is inflation coming back again? Well, what I'd like to do in our few minutes here is to talk about that when people think about the future, they often jump to the most likely risk and think, look, there's a potential, it might play out that way, what would we do about it? But really, as policymakers and also indeed as commentators and people observing markets, we need to think very much about what is the likelihood that this risk will actually play out. So I'd like to spend my time first talking a little bit about the sorts of concerns that have led to people starting to think, is inflation coming back? Secondly, run through some of the evidence about whether that's likely to play out in the future. Thirdly, move on to central bank frameworks and whether they're still able to manage inflation pressures, even if they were start to rise. But then finish up with some of the risks that we do need to keep a pretty close watch upon. So let me first start by moving to this one. So that graph on the left-hand side of your screen is really one that started getting the inflation talk going in earnest. This is the graph of the consumer price index for the United States for the year until April. And you can see from the blue line, it came in at over 4%, which is much higher than it had been before. In some ways, this was kind of validating the concerns that some people had that the large levels of liquidity injected by central banks around the world over the last decade, the low interest rate environment, the promise of central banks to keep interest rates low, and the very large run-up in government spending are all contributing to an inflation environment that's now starting to play out. Against the backdrop of that, we also have, of course, the COVID crisis, but the fact that, if anything, the world is coming out of that at a faster than expected pace. Demand and employment are recovering in most countries of the world, especially here in Australia. There's in fact some evidence of bottlenecks building up, which pushes up inflation within those markets. Part of that is COVID-related disruptions, but other parts are just the challenges of businesses having enough supply to meet the demand in certain areas. And of course, asset prices are rising as well. Well, if that's the kind of concerns that have started making people think about inflation, we really need to start thinking a bit about what the evidence of this. Well, to start thinking about evidence, you really need a framework. So I want us to spend a couple of minutes talking about how to think about inflation processes, because I think it will then discipline a bit as we pass through the evidence. This is a graph I like to call the Wiggles graph. Let me just spend a moment to describe what's going on here. Broadly speaking, the amount of output that an economy can produce increases at a pretty steady rate over time. We call that potential supply. What I mean by that is when the economy is at its full employment level, which is now somewhere between roughly 4.5% or so unemployment rate. It increases pretty steadily through time. Spending by households, businesses, government that tends to also increase over time, but at a much more volatile pace. So you can see from this graph that sometimes spending is total amount of desired spending is much higher than an economy can have. And sometimes, as in this one, it's much lower than the level of spending. Well, these sort of periods here are ones that are marked by very weak inflation pressure environments, and in particular, an unemployment rate that's above the full employment rate. But these ones here are when there's too much desired spending going on. Spending is higher than the level of output the economy can produce at full employment. These are the sorts of periods where inflation is rising, not just for 1 year, but tends to rise at an increasingly rapid pace over time. So very simply, just to recap, total potential output growing at a pretty steady pace, demand wiggling around, and when desired demand exceeds output, we get inflation. Well, why am I focusing on this framework? Well, because there are 4 key points that come out from this framework. The first thing is that it's not government spending that causes inflation. It's the total amount of desired spending that if that is above output. So people often look at government spending and say that will lead to inflation, but you've got to think about what's happening with the private sector spending, because that's what's in this total demand level. Secondly, it's not the amount of money that's injected in the economy, it's how much of that money turns into actual desired spending by households, businesses, or government. People often mistake that just because there's more liquidity being provided by the central bank, that will be inflationary, but that's only true if that liquidity is actually spent on goods and services. Thirdly, it's not the pace of recovery of GDP growth that looks very high when you're coming out from a bad period. It's whether or not the total amount of spending starts to exceed the level of potential output. You can have downturns that are quickly recovered that looks like very rapid growth, the sort of thing that's happening in the United States and Australia now, but that won't be inflationary until we've used up all of the excess labor resources. And finally, the fourth point that comes out of this, it's not just temporary blips that happen in the measurement of prices and the change in prices. Inflation is an ongoing issue where demand remains high for an extended period of time, pushing up inflation along the way. Okay, well, now that we've done the heavy lifting of laying out a framework for inflation, let's start to look at some of the evidence that's there. Well, the first thing I mentioned when I talked about that framework was about total demand. Private sector demand, which is a large part of total demand within an economy, has actually been pretty weak for an extended period. In fact, ever since the global financial crisis. Just look at this graph over on the left-hand side. The saving rate in Australia is much higher than it was in the earlier period. Now, if households are saving more, then that means that there's also going to be a lower level of spending by households. By definition, they get an income, they save more of it, so there's less consumption going on. So there's not as much demand for goods and services by the household sector as there used to be before from their incomes. And over here, we get the spending that businesses would like to do on new goods and services via investment. You can see that after the global financial crisis, there was a bit of a run-up as we finished the mining projects, but after that time, business investment has remained very low. So in fact, the private sector spending is still falling short of the sorts of levels that you would be expecting to have a robust economy growing at roughly the pace of full employment. And it's exactly that kind of concern that's been driving the stimulatory public policies going on. In other words, the public sector is trying to compensate for the fact that the private sector doesn't want to spend to the full amount necessary to employ all the labor. Here we have over on the left-hand side that very large injection of liquidity that's been going on actually for ever since the global financial crisis. You can see it's pretty high here, and it's especially high in the COVID crisis. But credit, the amount of borrowing by the private sector to undertake their spending activities has actually been falling and is still very low. So again, this is a story whereby you can inject liquidity, but that doesn't mean that people into the banking system, but that doesn't mean that people are going to take that liquidity and want to turn it into spending on goods and services, which is what you need if you're going to start an inflation process going on. And it's because of that lack of private sector that's been so ongoing that we've seen over here governments stepping in and trying to do the spending on behalf of the private sector, try to get total spending up to the potential level of output that we saw in the Wiggles graph. That happened post-GFC in this period, and it's happening again in the post-COVID crisis as well. Well, is there enough spending even with the government going on? Well, if there was, you would have expected that there would not be much underutilized labor available. Now, in fact, the unemployment rate has never got back, it's only briefly got back to its full employment rate since the global financial crisis, spiking back up again in the COVID area, and is still above where we were before the COVID crisis began. So there's still some excess people who are not employed. The purple graph is an interesting one. You can see that over time, the amount of people who are employed but who would like to be working more hours, another measure of excess labor, has actually been growing relative to the unemployment rate. This wedge is rising. Although that too is a labor that is in principle available to be better utilized. And you can see that it's still at quite a high level, suggesting that even with all of the stimulatory policies going on, it hasn't yet been sufficient to be able to fully employ all of the excess labor, and we'd be back at full employment. Not surprising, given that there's still excess labor, wage pressures have remained very, very weak. In other words, that workers are quite reluctant to push too hard to get wages because they know that there's actually quite a bit of excess labor still around, which is another way of seeing that, in fact, we're still not at the point where the total amount of demand is exceeding potential output, which is the underlying fundamental of the beginning of an inflation process. Given all of that, you'd expect inflation would not be particularly high once you strip away some of the temporary factors that have been pushing up inflation. That consumer price index graph that I showed you before includes all prices, and the most volatile one of that is petrol prices. A year ago in April, petrol prices were very low. The COVID crisis was spreading rapidly. And so a year later, things are much better, and petrol is in fact close to the level that it was before COVID hit. So it's not surprising that you would see a sharp downward movement in the overall CPI last year that would then be compensated by a sharp upward movement in the month of April and continue into May. That's what's really been driving that rapid rise up to 4% in the United States. It's temporary factors. The question is, are they going to last? And that gets back to the story that we just discussed, where we were saying, well, look, actually, if you look back at the sort of fundamentals, how much demand is growing relative to potential output in the economy, that straight line that we showed earlier on, you can still see that there aren't a lot of fundamentals falling into place to expect that there's going to be a large inflation outburst. And in fact, if you look at the financial markets, that graph on the right, you can back out their expectations of inflation over the next 5 years. They've increased a bit from around sort of, 1.5 to 2% up to about 2.5, but that's still not showing a large inflation outbreak. So overall, we have to conclude that, look, the evidence so far is not one to say that we're on the cusp of a new return to moderate to high inflation pressures, at least in advanced economies. I want to move on to now a second aspect to say, well, look, would a little bit of inflation actually be a good thing? And can the central bank still maintain inflation rates at roughly their target? In answer to the first one, central banks are actually actively trying to lift inflation back towards their target rates. I mentioned most target rates are somewhere in the order of 2, 2.5%, 3% or so forth. Inflation in most advanced economies has been below that level for the last decade. So in fact, central banks are trying to gradually reflate the advanced economies back towards their kind of 2 to 3% targets that they all have. That would be good if they were able to do that, because then they could start lifting their policy rates so that they wouldn't be zero, and central banks could start taking on more of the typical demand management tasks. But inflation, once it starts rising, can in fact grow its own legs, where if everyone expects inflation to rise, it can start being built into contracts. So central banks are very cautious to make sure that they can still use their framework to manage the pace of growth of prices. Is that still effective? Well, I would argue that yes, it is. Central banks still have a pretty solid understanding of the inflation stability framework. They really haven't changed that much. They are still able to raise rates, and by doing so, make it less attractive to borrow and to spend, and to have mortgages rise, and so that there's less non-mortgage money for households to spend, especially in Australia. Some people say central banks can't do that now because there's a much higher level of private sector debt. But if you think about it, that just means for each quarter point rise, the central bank gets more bang for its buck than it used to before. So it's still effective. It just means it may not have to rise as much to achieve the same level of spending constraint. Central banks can still withdraw liquidity by selling bonds into the market, just like they did beforehand. And so they're able to not just inject liquidity, but also to bring it back again into the central bank to the extent that they start seeing concerns about liquidity being used for spending on goods and services, which is a threat to inflation beyond the target. And finally, they remain independent and hence able to use the tools that they have in order to manage the inflation process. But I'm not saying that, of course, there aren't risks. The future, as I mentioned up front, is unknown. We can't be absolutely sure of what it will do and how all these various channels will play out. And in fact, all policy is always a challenge because of the uncertainty of the leads and lags and how the private sector will respond to different policies. That's even more so the case right now because we're still kind of grappling to find out what is the new full employment level, particularly in a post-COVID world. There's been rapid changes in the nature of employment in different industries, some rising, some falling. Think about IT and online as a growth. Think about some of the travel arrangements in Australia as a contraction in the size of those industries. We've also got a change in the technology set. You can think about labor as being unskilled and skilled, where you might have a shortage of one type of labor, let's call it skilled, but more unskilled labor around that doesn't have a home to be employed. So all these are challenges to work out exactly what we mean by full employment. The government has the same kinds of challenges in thinking about how does it bring the deficit back down again at a pace that doesn't have too ambitious a target, but also not be too lacking in ambition, such that deficits remain too long when the private sector has already responded. Ultimately, many of you are thinking about what does all this mean for financial markets? All changes in inflation rates, even if they're small, have an impact on the prices of different assets. And perhaps this is where a lot of the concern and question is coming in as inflation gradually rises back towards central bank targets. The Fed has of course changed its monetary policy environment. It's much more willing to wait for longer now to see inflation rising than it was under the previous regime. Perhaps that adds some volatility as people get to understand what this new monetary policy arrangement is, and that could lead to more volatile asset prices within private sector markets. In general, both equity and bond markets are kind of priced for a very low inflation environment. So there's some adjustment in prices that will occur to the extent that we move out of those super low inflation environments and start moving towards a more normal environment. In general, that's another way of saying that asset prices are very high. Now, there's been lots of work shoring up the financial sector after the global financial crisis to make sure that the right people are getting credit to purchase assets. And we'll have to see whether or not those new regulatory arrangements are able to ensure we continue with the resilience we've been seeking for as inflation moves a little higher back towards targets. And remember, as I mentioned before, inflation is something that's quite tricky to control. Once everyone expects inflation to be a level, it tends to be validated. That's good if that's the level that the central bank is targeting. It's not good if that's above what the central bank is targeting. And so therefore, it's going to be very important to ensure that we continue to have very clear communications about how this reinflation process is working, how central banks can ensure that they manage it so that inflation settles at around its targets, as we all watch and wait and see how the future plays out as we continue to moderate and manage macroeconomic trends. So with those comments, let me just stop there, and perhaps we'll see if there's any questions. I think, Suzanne, you'll bring those in if there's anything that we should cover quickly before we then turn to Lindsay, who I think has a few words to talk about the programs here at Macquarie.
Thanks very much, David. We do have some great questions. Our first question comes from Mark, and the question he is asking is, how much credibility should be placed on the bond break-even inflation and swap break-even inflation levels as accurate measures of market expectation for realised headline CPI?
Look, that's a great question, Mark. And so the answer is, first of all, that's real money on the line. So people are actually putting in, on average, an expectation that that is going to be the number that plays out. Now, this is nonetheless still a pretty volatile series. As new information comes through, as we learn more about the future because it becomes the present, those sort of rates change. They're not the only inflation expectation measures we have. We also have others that come from surveys and so forth. But all of them are, broadly speaking, showing the same kind of an indication. An uptick in people's expectations of where inflation will be relative to where it has been, say, 3 or 4 months ago, but not a large breakout. That's the same sort of information that we are seeing from a number of different sources. So it's not so much the accuracy of whether the financial markets have got it exactly right. They can no better predict the future than any of us can. But what I take some comfort in, and I think others do, is that there's consistency across all the various measures that we're looking at.
Thanks very much, David. Another question here from Arash. Hi, David. About the framework, is spending on investments included in the total spending? And if yes, could it be that injecting liquidity will not necessarily increase the price of consumables, but will increase the price of investment assets? I'm guessing in a low rate environment, people will invest more on equity, for example. Great question.
Yeah, so look, that's a terrific question, Arash. I hate to kind of run straight to the economist language here, but when we speak about spending by businesses, and particularly when we use the term investment, we mean really investment in new goods and services, which in businesses' case is really building buildings or putting in machinery. We don't mean buying financial assets like equities, and we don't mean buying existing physical assets like homes. We only talk about new forms of investment, new goods and services that are produced. So when people are actually using liquidity to buy an asset, that's not going to be picked up as a rise in investment from an economic perspective. Now, if asset prices are rising, there is something called a wealth effect. where if people feel like their financial and physical assets are worth more, they might go and be more willing to spend on holidays or other things. That, of course, is picked up in consumption. So the question you're getting at is really this distinction between how the market uses the word investment and how economists use. That Wiggles graph is very much an economic concept where we're focusing on the rise of investment, the use of savings for investment purposes on new goods and services. And it's that has been falling short for the best part of a decade.
Thanks, David. Another question here from Mark. Central banks are trying to reflate economies. Given the monetary stimulus applied by the RBA, what do you think is the likely timing of transmission from initiation of the bond buying program to realised inflation?
I'm sorry, what was the end?
Realised inflation.
Oh, look, that's a very difficult question, Mark. You know, the leads and lags of ordinary interest rate changes are things that economists have spent many, many empirical studies looking at. Generally, it turns out to be somewhere in the order of 12 to 18 months for the most effective period, perhaps 12 months for interest rate changes. We really don't have a very good indication of the leads and lags for quantitative easing leading into the inflation process because it's just too new a process that's been around to be able to come up with that. So I don't like to duck the question, but it's not something that we have a pretty good handle on. We know the direction of movement, but the magnitude and the timing is very hard to pass out.
And one last question before we pass over to Lindsay. It's from Singita, and she's asking, will an interest rate rise have a major implication for the housing market in Australia? And I know I'm interested in this question, David.
Look, housing is both a requirement for people to live in and also as an asset. Whenever interest rates are rising, then obviously people are thinking about the cost of their mortgages, the cost of purchasing the asset in general through debt, and their ability to service that debt. The higher the interest rate, the harder it is to service it. So generally, you would expect that the lower the interest rate, the more the demand for housing. That's what we've seen to date. And vice versa, the higher the interest rate, the slower will be the demand for housing. Now, that doesn't mean that you can say just because the housing market, both in activity and prices, slows, that there's going to be a large change in prices, like the big decline in prices that people can fear about. Australia's housing market is fairly resilient overall in terms of what goes on. What's important is to make sure that the level of unemployment is managed within the economy, that it doesn't rise, because that's really when you start getting serviceability problems. And ultimately also, of course, that lending standards are strong to make sure that the people who do get the loans are able to service it, not just in the good times, but when the economic environment is not as strong as well. There's a lot of effort that's been done by Australian policymakers to try to shore up that. So I think in general, the housing market will ebb and flow, but it's not likely that you're going to see a rapid change in the fundamentals that are going there.
Thank you, David. So in partnership with the Australian Financial Markets Association, AFMA, the Macquarie Business School Financial Markets Certificate is actually a new offering that we have at the Macquarie Business School. To talk more about that and to actually understand more about financial markets that you might want to know, I'm going to hand over to the course director, Lindsay Ryan. Good morning, Lindsay.
Thank you, Suzanne and David and everyone for coming along today. It's great to see a discussion about financial markets and also inflation, because they are very important and they go together. For my part, I'd like to talk a little bit more about the Financial Markets Certificate course, which is endorsed by AFMA and is a pathway to AFMA accreditation, and the possibilities for further learning beyond the AFMA Financial Markets Certificate. The course actually covers a lot of the issues that David has been talking about. They are front and centre of some of the early units, as inflation expectations have a substantial impact on financial markets. Whatever your background, if you want to acquire financial markets knowledge, if you are working for the first time in financial markets and need accreditation, or even if you find yourself in an area where you do require accreditation and you may want to go on to do further learning, the Financial Markets Certificate can help you. And one of the things is that if you want to further your career, you might want some more learning, you might want lifelong learning. So beyond just how the market works, economic factors, the products and risk, the course provides employees of member firms with their accreditation and also enables them to demonstrate their professional credentials. By doing our financial market certificate, they actually gain some credit points towards Macquarie Business School courses. So there's opportunities for lifelong learning, particularly with the Master of Applied Finance. So if you were to qualify for the Master of Applied Finance, then it's possible that you would gain credit points that you could use in completing that course. If you are interested in more basic financial knowledge, then that the financial market certificate accounts for half of a graduate certificate of finance. So there are some substantial benefits that are available potentially to particular students. And so if you'd like to hear more about that, you can contact me or the team on the details on the next slide, which I'll just ask David or Suzanne to put up. There you go, stay connected with us. We're more than happy to discuss how the financial market certificate and indeed our suite of courses can help you to get where you want to go. So thank you very much for your time today.